Hello class 9, welcome back to another session of Commerce class. This is your Avijit sir, and today I'll be presenting you the topic Finance and Accounts. Meaning of finance. Business finance may be defined as the activity concerned with planning, raising, controlling, and administering of the funds used in business. It involves estimation, acquisition, and administration of funds of any kind used in meetings the need and objectives of business firms. So students, finance, or in other words, you can tell capital or money, has been called the lifeblood of business. Every business requires funds for its activities, and sound management of funds is essential for success in business. What to buy, where to get the money to buy it, and how to manage it once you have it. So all this we will learn from finance and accounts. So important terms in finance. First is fund. A fund is a pool of money set aside for a specific purpose. Those pools are often invested and professionally managed. Corporate finance. Funds used in companies are known as corporate finance. It is the area of finance that deals with source of funding, the capital structure of corporations, the actions that managers takes to increase the value of the firm to the shareholders, and the tools and analysis used to allocate financial resources. Next important term is financial management. Management of financial activities of a business is known as financial management. It may be defined as the area of functions in an organization which is concerned with profitability, expenses, cash, and credit, so that the organization may have the means to carry out its objectives as satisfactorily as possible. Next important term is liquidity. It means availability of adequate cash or cashable funds to meet the needs of business whenever necessary. Next term is debentures. A debenture is a medium to a long-term debt format that is used in large companies to borrow money. Next important terms is profitability. It refers to the profit earning capacity of business. It is the ability of a business to earn a profit. A profit is what is left of the revenue of a business generates after it pays all expenses directly related to the generations of the revenue, such as producing a product and other expenses related to the conduct of business activities. Next term is solvency. It implies the ability to repay its debts or loan at the right time, which requires that its assets are more than sufficient to meet the liabilities. It is the degree to which the current assets of an individual or entity exceeds the current liabilities of that individual or entity. Solvency can also be described as the ability of a corporation to meet its long-term fixed expenses and to accomplish long-term expansion and growth. Next important term is debts. It is an amount of money borrowed by one party from another. A debt arrangement gives the borrowing party permissions to borrow money under the conditions that it is to be paid back at a later date, usually with interest. It is also known as loan. The last term is equity. In finance, equity is ownership of assets that may have debts or other liabilities attached to them. Equity is measured for accounting purposes by subtracting liabilities from the value of an asset. For example, if someone owns a car worth rupees $9,000 and owes rupees $3,000 on the loan used to buy the car, then the difference of $6,000 is equity. Function of Finance and Accounts Department. Estimating the financial requirement. First of all, the total amount of funds required during a specific time period in the business are estimated. Accurate estimate of the financial needs is necessary to avoid excess and shortage of funds. In business, funds are needed for fixed capital and working capital. Therefore, estimate must be made for both long-term and short-term. The total amount of long-term funds is known as capitalization. Next, number 2 is designing the capital structure. Capital structure refers to the kind and proportion of different securities used to raise the estimated amount of funds. Once the amount of funds to be raised is estimated, the sources from which the money to be collected are decided. Funds can be raised from equity shareholders, preference shareholders, or debenture holders, banks and financial institutions, public deposit, etc. The sources of funds should be selected carefully, keeping in view the amount and type of funds required and the merits and demerits of each source. After selecting the sources of funds, the relative proportion between equity capital and debt is decided. This is called capital structure. So what is capital structure? Capital structure means the type of securities to be issued and the proportionate amount that makes up the capitalizations, and a proper balance between equity and debt is necessary for the financial health of the business. Number 3 is raising of funds. After the sources of funds and the relative propositions between them is decided, steps are taken to collect the necessary funds. And for this purpose, a prospectus is prepared and approved from SEBI, Security Exchange Board of India. Underwriters and brokers are appointed for the sale of shares and debentures. Advertisements are released, agreements are made with financial institutions for raising loans, etc. The number of shares and debentures to be issued and the term and conditions of issue are decided before the issue of prospectus. Next is investment of funds. Effective utilization of funds is essential for the success of business. Prudent investment of funds is necessary for profitable use of funds. The investment of long-term funds is decided through capital budgeting. Several techniques are used for the evaluation of alternative investment proposals. Investment decisions should be made keeping in view the objectives of liquidity, profitability, and solvency. As the future earnings are unknown, investment decisions involve some risk. Attempts should be made to maintain the right balance between risk and return on investment. The greater the degree of risk, the higher should be the return. Next is management of cash. Adequate amount of cash must be made available in business at all times to meet day-to-day expenses. Availability of cash is necessary to maintain liquidity and creditworthiness of business. At the same time, idle cash should be avoided as it involves loss of earnings. Efficient management of cash inflows and cash outflows is necessary. Cash flow statement, cash budget, funds flow statement, and other techniques are used for this purpose. Disposal of earnings. Administration of earnings is an important function of finance department. It involves decisions relating to dividend policy, plowing back of profits, creation of reserves, etc. Such decisions are made on the basis of the amount and trend of the firm's earning, capital market conditions, modernization and expansion plans, taxation policy, etc. Financial controls. Evaluations and control of financial performance is necessary for ensuring the financial health of the business. It involves the development and use of appropriate control techniques, return on investment, budgetary control, internal audit, ratio analysis, break-even analysis, and several other techniques are used for this purpose. And the last point is accounting. In most firms, finance and accounts are combined into one department. In some very big firms, finance and accounts are two separate departments. Accounting is the art of classifying, recording, analyzing, and interpreting business transactions. Accounts needed to be maintained not only to ascertain the profit or loss of the business, but for several other uses. Financial accounting, cash accounting, and management accounting are the three branches of accounting. So with that, we come to the end of this chapter. I hope everybody have understood the lesson. We will soon meet in our next session with a new chapter. This is your Avjit sir signing off. Till then, take care. Thank you.